No, let's look at the absolute foundation on the financial markets. Every major portfolio you see is an anchored by two fundamental asset classes, which boil down to a simple choice: lending versus owning. When we talk about ownership, we are talking about equity, buying a piece of a business. When we talk about credit, we are talking about bonds, lending money to an entity. Let's break down how these two drivers shape the markets. Moving forward, let's explore the two primary ways to deploy capital in the market: action and obligation, or simply put, owning versus lending. On the left, we have action, which represents ownership. By buying a share, you become a co-owner, sharing in both profits and the losses with a potential higher but variable return. On the right, we have obligation, which represent lending. Here you act as a creditor, lending money for a fixed, predictable interest payment over time. This path generally carries lower risk because your repayment is contractually owed. Balancing these two families is what building a portfolio is all about. Now, let's deep dive deeper into the ownership side of the equation: stocks or action. When you buy a stock, you receive fractional ownership, giving you a real legal claim on a slice of the company's asset and future earning. Along with the ownership come voting rights, allowing you to have a say in a major corporate decision like a board election and mergers. The upside here is a variable: uncapped returns, meaning your potential gains from dividends and price appreciation have no ceiling. Fourth, they also have no floor. However, that high upside comes with a major trade-off: you are last in the line. If the company failed, shareholders are only paid after all creditors and bondholders are fully settled. Let's look at the other side of the coin: bonds or obligations. Unlike stock, buying a bond means you are making a loan, not buying a stake. You hold the debt of the government or a corporation for a set period. In exchange, you receive a fixed coupon, which are predictable, scheduled interest payment at a rate fixed from a day one. At the end of that term, known as the maturity date, you received your original principal back in full, assuming no default occur. because you are a lender. You hold priority in a repayment, meaning if the issuer faces financial distress, you are legally paid back long before any shareholder see a dim. To bring everything together, let's look at stock and bond side by side across our key criteria. As an equity investor, you are a co-owner with voting right and the potential for a variable dividend. But you take on a higher risk tied directly to business performance and sit last in a line for repayment. On the flip side, as a bond investor, you are a creditor with a contractual right to fix scheduled interest payment. Your risk is lower because it is backed by a legal claim, and you hold priority repayment over shareholders in the event of a default. Ultimately, building a balanced portfolio is about weighing the growth potential of ownership against the structure, income, and safety of lending. Now let's visualize where these asset classes sit on the fundamental risk spectrums. It all comes down to a core trade-off. Trading upside for certainty or accepting risk for growth. On the left, bonds represent the lower risk, lower return side of the spectrum. Focus heavily on a capital preservation and a predictable compound payment. As we move to the right, we shift into a stock. Here we accept a higher risk and a higher volatility in exchange for uncapped upside, long-term growth, and dividend potential. Understanding the spectrum is a crucial as it dictates how an investor balances safety with wealth accumulations. To wrap up everything up, let's look at the key takeaway from today's session. First, wine on land is the fundamental fork in the road. Every security ultimately boils down to a claim of equity or a claim of debt. Second, remember that ownership brings a voice and share upside through a voting right and uncapped profit potential, but you must also share in the losses. Third, lending brings predictability and priority, securing fixed coupon and legal repayment ahead of shareholders. Ultimately, the master trade-off is risk versus certainty, and blending these two asset classes is exactly how investors build robust portfolios that balance and grow again and stability. That's it for today, guys. Thank you very much. See you soon.